This is a question that I'm sure has crossed many people's minds. The United States has a debt of exactly $37 trillion. That's a number so large it's almost impossible to comprehend. But at the end of the day, it's money that's owed to someone. People usually point to China as the biggest lender. And indeed, China holds about $750 billion worth of US debt. But here's the interesting part. China itself is drowning in debt. Its own debt exceeds $12 trillion and is still growing. So who holds their debt? A large portion of it is held by Chinese banks, but these same banks also hold American debt. Meanwhile, American banks hold debt from China, Europe, and almost every other country. Does it sound complicated? That's because it really is. The deeper you go, the more intertwined the system becomes. Every country borrows, every country lends, and somehow around $300 trillion of debt circulates around the world. That's 3 times larger than the entire real global economy. But if the world is this deep in debt, who exactly is everyone indebted to? It's not just some strange accounting trick. It's a clue that something much deeper lies beneath the surface. Searching for that answer reveals that the modern world is not built on stability, but on motion, an endless cycle of borrowing, lending, and reinvesting. This is the story of how global debt became the engine of the modern world, and what could happen if people suddenly stopped lending. Debt may sound like a modern problem, just a big, frightening number on a government spreadsheet. But debt is actually one of the oldest ideas in human history. Long before banks, paper money, or even coins, debt was simply a promise. Imagine this. In spring, you lend your neighbor a sack of grain. When harvest season comes, they pay you back, maybe with a little extra to say thanks. No interest rates, no contracts, just trust. Thousands of years ago, humans understood a simple concept. Sometimes you need something now that you can only pay for later. That's the essence of debt, borrowing from tomorrow to solve today's problem. Over time, this simple personal exchange evolved into something far bigger. Kings wanted to build castles, empires needed ships and cannons, but a single lender couldn't cover the costs. In the 1600s, England faced exactly this problem. King Charles was preparing for war with the Dutch, but the treasury was empty and nobles refused to lend. So they tried something new. They sold small pieces of debt to the public. Citizens handed over cash and in return received a written promise that it would be repaid later with interest. A bond. A simple idea, but it changed everything. Now, governments could raise massive amounts of money without raising taxes or depleting treasuries. By the 20th century, bonds had gone global. World War I and II pushed nations to borrow on an unprecedented scale, not only to fight, but to rebuild. Then, in 1944, the Bretton Woods Agreement placed the US dollar at the center of the global financial system. Currencies were tied to the dollar, and the dollar was tied to gold. But gold was limited, and economies needed to grow. As U.S. spending increased, there simply wasn't enough gold to back all the dollars in circulation. So, in 1971, President Nixon broke the link and ended the gold standard. From that point on, money wasn't tied to gold or any physical asset, only to government decree. This new system was called fiat currency, from the Latin word meaning by command. Governments could now create as much money as they wanted. And if that sounds like the recipe for endless borrowing, you guessed it, it was. Starting in the 1980s, global debt exploded. Countries realized borrowing wasn't just useful in wartime, it could also fuel growth. They borrowed to build schools, fix roads, and lift economies out of recession. Debt became the engine of progress for both developed and developing nations, and eventually it became the new normal. Today, debt is how projects get built, how crises are managed, and how promises are kept. As a result, Global debt has become a massive mountain exceeding $300 trillion, more than 3 times the world's total annual production. To visualize that, if you stacked $300 trillion in dollar bills, it could reach the moon and back 50 times. That's how huge this number is. So, if every country is borrowing, who are they borrowing from? And if everyone owes everyone else, who is collecting the money? When people think of national debt, they imagine some powerful, shadowy figure pulling the strings. But that's not how it works. Modern debt doesn't move in a straight line. It moves in circles. To understand this better, let's look at the most indebted country in the world, the United States. You might wonder, who lends them all this money? Well, here's the surprising part. About 70% of U.S. debt is owned by Americans themselves. In other words, the U.S. owes itself. And how does that work? When governments want to borrow money, they issue bonds and promise to pay them back with interest, just like a person taking out a bank loan. But who buys those bonds? Probably you. When you deposit money in a bank, it doesn't just sit there. Banks put that money to work, lending and investing it, including buying government bonds. Bonds are incredibly popular investments because they're one of the safest ways to earn interest on excess cash. They don't fluctuate daily like the stock market. Of course, governments can adjust interest rates to manage the economy. In the 1980s, bond yields soared above 15% to combat inflation. During the COVID recovery in 2020, rates dropped below 1% to encourage spending. But when you buy a bond, the interest rate stays fixed until it matures, no matter what happens later. Today, a 10-year U.S. bond pays about 4.5% annual interest, a solid return given the near-zero risk. And that's why bonds, and debt in general, remain so popular. And it's not just banks. Anyone with large cash reserves buys bonds. Pension funds, insurance companies, and investment firms all do it. In 2024, U.S. pension funds invested a quarter of their assets in bonds. For insurance companies, the share is even higher. Over 60% of their portfolios are in bonds. So this creates a hidden network where people's savings become loans for the government. So while it might sound strange that America lends to itself, it's really just money moving from where it's idle to where it's needed. When the government pays interest on its debt, that money flows back to the lenders, who now have more cash to reinvest. And what do they do with it? They buy more bonds, earning more interest. The system becomes a self-sustaining loop where money constantly circulates, from lender to borrower and back to lender again. The same cycle exists internationally. About 30% of America's debt is held by foreign entities. Just like U.S. banks or pension funds, foreign governments and banks invest their surplus cash in U.S. bonds. Money flows into the U.S. when it borrows and flows out when it repays. The cycle never stops. But remember, this isn't unique to America. Every country borrows and every country lends. Japanese savings become loans to the Dutch, Dutch savings fund Brazilians, and Brazilian savings flow back into U.S. bonds. Global debt isn't a pile of unpaid bills. It's more like an interconnected web where money constantly flows from savers to borrowers and back to savers again. Governments borrow, investors lend, and interest payments keep the system spinning. Sometimes the money crosses borders, but most of the time, it never really leaves the system. It just changes form and ownership before moving again. So, if governments keep borrowing and spending, how will they ever repay their debt? The answer is simple. They borrow new money to pay off the old. That might sound irresponsible, and in a way it is. But this is exactly how the modern global economy functions. Why does this system keep going? Why can't the world just decide to stop borrowing? Because everything, the economy, politics, growth, is built on debt. The truth is, debt drives growth. When governments borrow and spend, money flows into the economy. Companies earn more, workers' wages rise, and they spend more, creating a feedback loop of continuous growth. In China, about 19% of government spending comes from borrowing,
meaning 1 out of every 5 yuan spent is borrowed money. In the US, that number is even higher, about 1 out of every $4. If governments suddenly stopped borrowing, they'd have to cut spending, and the flow of money into the economy would abruptly stop. Companies would earn less, workers would lose jobs, and spending would collapse. The same cycle that fuels growth would suddenly reverse. Don't forget to subscribe to my channel and leave a comment.